Millions of Americans aged 65 and older are set to benefit from a new federal tax break beginning with the 2025 tax year, a move analysts say could have ripple effects across consumer-facing markets. The policy introduces a $6,000 senior tax deduction aimed at easing the financial burden on retirees, grappling with elevated costs for healthcare, housing, and daily essentials. Under the measure, eligible seniors can deduct up to $6,000 from taxable income, while married couples where both spouses are 65 or older can claim up to $12,000. The deduction is in addition to the standard deduction and existing age-based benefits. Full eligibility applies to single filers earning up to $75,000 and joint filers up to $150,000, with the benefit phasing out at higher income levels. The provision is temporary, currently scheduled to run through 2028. From a macroeconomic perspective, the deduction modestly increases disposable income for a large demographic that tends to spend predictably on healthcare, consumer staples, and services. While not large enough to shift GDP growth on its own, strategists note it could support earnings visibility in select sectors, particularly those with high exposure to senior spending. 3 stocks to watch: United Health Group, UNH. As the largest U.S. health insurer with significant Medicare Advantage exposure, United Health stands to benefit indirectly if seniors allocate tax savings toward healthcare services and supplemental coverage. Any improvement in seniors' financial flexibility tends to support enrollment stability and utilization trends, key drivers of long-term revenue growth. Walmart, WMT. Walmart remains a primary spending destination for retirees, especially for groceries, pharmaceuticals, and household essentials. Incremental cash flow from tax relief could bolster same-store sales volumes, reinforcing Walmart's defensive profile amid slowing discretionary spending elsewhere in the economy. CVS Health, CVS. With its integrated model spanning retail pharmacies, pharmacy benefit management, and healthcare services, CVS is well-positioned to capture additional senior spending. Analysts see the tax deduction as a marginal positive for prescription adherence and clinic visits, both critical to CVS's post-restructuring growth strategy. Market outlook: equity markets are unlikely to price in the senior tax deduction as a standalone catalyst, but it adds to a broader narrative of targeted fiscal support in an election cycle economy. For investors, the key takeaway is sectoral. Companies aligned with healthcare, consumer staples, and essential services may experience incremental demand support. While temporary, the deduction reinforces near-term consumption resilience among seniors, a demographic that remains one of the most stable spending cohorts in the U.S. economy.
Like and subscribe, follow for more informative content.